Hello and welcome to the Friday update. Well, the game is on. I don't know about you, but I have watched a lot of football. I've absolutely loved every minute of it. Last night's game was unbelievable. And tonight, the U of A will be playing, so you can watch that as well. Anyways, we made it another year in the business. So last year, old news. Now the game is just beginning again. Now, interest rates, mortgage rates, they stayed pretty steady over the holidays, ending up at 6.2% for a conventional 30-year fixed rate loan, according to my favorite website, Mortgage News Daily, the most exciting website on the internet. But if you want to track rates, it's a great website to go to. Now, trading on Wall Street was pretty light in the mortgage world during the holidays. So we'll take that stability, 6.2%. That's a great way to start the year. And it's about 1% below where it was last year. So we are definitely getting a kickstart to this year. Now, remember too, that FHA and VA rates are below 6%, which is a bit of a hidden secret because the media doesn't talk about it very much. Your buyers need to know this. And actually 60% of my business is FHA and VA. So let's go get them into a home with below 6% interest rates. Now, come Monday, guess what? Everybody is going to be back at work, all of Wall Street, all the financial markets, and we are going to be on a run. And we're going to start to see what Wall Street thinks will happen to the economy and interest rates this year. So all the normal market moving reports will be back on track, and traders can start to rely on the new data to make their trades. They were kind of on pause for the last quarter of the year just because of the government shutdown. Now we're getting back to normal. Now, one interesting thing that happened during the government shutdown was the market had to rely on private reports not controlled by the Fed. So some of the Fed reports, particularly the Bureau of Labor Statistics, the BLS jobs report, have definitely been flawed and shown to be pretty unreliable as major adjustments happen after the fact. So they look at the current reports that come out, make the trade, and then it all changes. So hopefully we'll see some adjustments to the BLS reports, and they'll upgrade the reporting to make it consistent with what we have seen from the private sector and more advanced reporting technology. So the Fed had those big misses last year when the actual figures were reconciled. And that said, it is clear right now that inflation is going down. We're headed in the right direction. Little by little, it's down to 2.6%. The Fed target is 2%. However, it does not remove the feeling that the consumer has that prices are still way too high. The runaway inflation that peaked at 9.1%, it didn't go away. It stayed in the price, but we're just seeing less increases in prices. So perfect example. Let's say you had a widget. I don't know what a widget is, but it's a little widget. $10. If it costs $10 before that 9.1% inflation, that widget would have gone up to $10.91. Now, even though inflation is back down to 2.6%, well, guess what? That widget now costs $11.19. Not as big of an increase, only 2.6%, but it still went from $10 to $11.19. It doesn't feel good. It doesn't feel good for the consumer, but inflation is still coming down. The tariffs that they thought would be a problem are through the pipeline. Now, the previous inflation, again, did not go away. Consumers are still of the perception that things are unaffordable, but they are getting better. We did get a win with gas prices. Gas has gone down considerably. We are roughly about $2 per gallon below the highs at the gas pump. So that helps. It was about $5 at the peak, and now we're about $3 today. So looking ahead, most reputable forecasts expect mortgage rates to stay in the low sixes this year. Top tier buyers may even dip into the fives. But what is not on the radar is a return to the twos, the threes, or even the low fours. It is time for buyers to reset their expectations on focus on opportunity, not nostalgia. It's not going back to the twos, threes, and fours. Now, join Sam and me on the Friday playbook for our full 2026 forecast. We're bringing insights from one of the most trusted voices in our industry. He's a 4-time Crystal Ball Award winner, recognized by Pulsonomics. Pulsonomics does a report. They compile forecasts from over 100 economists, financial and real estate professionals. It's a very good report. And our friend has won 4 Crystal Ball Awards. So he's pretty good at forecasting. We will break down everything in simple, practical language that you can provide to your buyers, provide handouts. You can download them and use them to show them your knowledge in the industry and let them know what they can expect in this coming year. So our goal is to make you the expert so you can guide your buyers and sellers with confidence. The registration link is below. So 2026 is shaping up to be a better year than the past 3. It's been down. It's been tough for everybody, myself included, but we're going to make this year a better year. Stay ahead of the curve, have some fun, and let's help more families buy and sell real estate this year. So game on. Let's go. Go Arizona Wildcats. And we'll see you next week. And again, join us for the Friday playbook. This is Gaylord out. Hope you had a great New Year's. Bye-bye, everybody.